Hello, I'm Patrick Hopper. Today I want to talk about trade policy when there is monopoly power in trade. Monopoly power in trade is the situation that we have when we have a large country, so large that it can affect the global price for the good, the terms of trade. That's how we define a large country, in fact. This is true for both importing nations and exporting nations, but in this video I'm going to be focusing on importing nations. The intuition is as follows. When you have monopoly power means that you can set your own price. When you have monopoly power, you can actually change the terms of trade in your favor by doing a policy within your own country. The policy can either be a trade policy or a domestic policy. All right? In the presence of market failures, and this is the important part, by changing the policy and therefore influencing the terms of trade, the country can actually make the entire country better off. You can increase national welfare. And that is not possible in a world without market failures. However, whether you have market failures or no market failures, it's always true that any policy will have both winners and losers. So that is still true. The question here is only, can the country, by imposing an import tariff, actually make the entire nation better off? And the answer is maybe. It is possible. It depends, of course, what policy you are doing, whether you're an importing nation or an exporting nation. But more importantly, it depends on the size or the magnitude of the policy that you adopt. In all these cases, the intuition is going to be as follows. Whenever you do a domestic policy, whether it's a trade policy or like a purely domestic policy, like a pollution tax or something like that, there will always be a deadweight loss. So whenever you change the price, there will be production distortion cost and consumption distortion cost. Well, actually, that's true only for a trade policy in an open economy, but that's the one we'll be focusing on right now. So that is, of course, bad for national welfare. That deadweight loss is going to reduce national welfare. But here's the thing. If the country, by imposing that policy, is able to change the terms of trade in its own favor, then that terms of trade effect could actually outweigh the deadweight loss from the policy itself. And it is that offsetting mechanism that could make the country better off than it was without an import tariff. All right, so this is what I'm going to try to explore in this diagram right now. So first of all, this is a large importing nation. And suppose this nation adopts an import tariff. The first effect is, of course, that the price of foreign produced goods will increase. I'm going to draw this right here. The first impulse is to think, okay, well, domestic consumers, they can just switch over to domestically produced goods because the domestically produced goods will not be taxed at the rate of the tariff. However, when demand shifts over to domestic producers, there is no way the domestic producers can satisfy that increase in demand. So we will have a domestic shortage. And of course, the impact of the domestic shortage is that the internal price, the price charged by the domestic producers, will increase. In fact, the price will increase until the domestic shortage is completely gone, which is true when the internal price, the price charged by domestic producers, is exactly the same price as the foreign producers' goods cost the consumers in this country. So this new price line over here applies both to foreign produced goods and to domestically produced goods. Of course, when the prices change and the price is now facing the same price facing both producers and consumers in this country, producers and consumers will change their behavior. So producers, when they can sell their goods for a higher price, they will decide to produce a greater amount. So we have this a new QS1 here. Consumers, of course, facing a higher price, decide to cut back on quantity demanded, leading to a quantity demanded which is less than it was before. Now, if the price and the quantities change, that will give, drastic welfare impacts on this country. And I'm going to talk about these welfare impacts by labeling the areas. So I'm going to say this is area A, B, C, and D right there. Hopefully you can see that. So if you just look at consumers first, consumer surplus is going to change because of the increase in the price and the reduction in quantity. In fact, consumer surplus is reduced by areas A, B, C, and D. If you remember, consumer surplus is the area below the demand curve, above the price that consumers pay. And since price has now increased, you lost those four areas, A, B, C, D, from consumer surplus. Producer surplus actually increases. Producers are happy that the price they can sell the good for is higher, and they can sell more goods. So the increase in producer surplus is area A. And producer surplus, if you recall, is the area below the price that producers receive and above the supply curve. So that has now increased by A. Of course, the import tariff generates government revenue to the domestic government. And you can see here that the tariff that they pay, it's the difference between these lines, and the amount of imports after the tariff is equal to QD1 minus QS1. So C shows the rectangle of tariff revenue. And that is something good for the government. They collect that, so that's area C with a positive sign. Now, if this was a small country, this will be the end of the story. And you could have done welfare analysis here, and you can see that the net effect, because the A's cancel, the C cancel, and the net effect will be minus B and D. And if you look at the diagram, these are, of course, the deadweight losses. B is the production distortion cost. That is the cost associated with domestic producers that are less efficient, ending up producing too much of the good. And the consumption distortion cost, D, is the fact that consumers are paying too much and consuming too little compared to what the market really wanted them to do. So those two distortionary costs leads to the deadweight loss of minus B and D. And if this was a small country, we would conclude that import tariffs are definitely bad for the entire nation. However, today we're looking at a large country. A large country can affect the terms of trade. They can change the terms of trade in their favor. So what happens is, of course, that after the price increased and domestic producers increased their production, domestic consumers reduced their consumption, imports fell. So when this large country reduced the number of imports, the demand for this imported good goes down. And of course, when global demand for the good goes down, the price of the good will fall. So again, the price of the good is the terms of trade, the international price. So I'm going to draw in the fall in this price. So suppose that the terms of trade goes from TOT to TOT prime. So the terms of trade, the price that this country is paying for the imported goods has fallen. That's going to give us a new area in this diagram. I'm going to call that E. And what the importance of this area is that now government revenue And I'm not going to redraw this diagram. But now what we're going to have is that government revenue is going to be the difference between the terms of trade and the price paid in the country. And of course, if you're paying careful attention here, you can notice that when the terms of trade fell, but the tariffs stayed the same, we really should have moved this top line down a little bit. But I'm going to ignore that right now. So if we don't move that down, then government revenue will be the two areas C plus E together. All right, so what that means is that part of the government revenue is paid by domestic consumers, but part of that revenue actually comes from the fact that foreign producers are forced to accept a lower price. So in effect, they are paying some of the government revenue. And that collection, that terms of trade effect, is a positive thing for this large country. All right, so if I put that back up here, we have now that government revenue is plus CE. And if we did the welfare analysis, we get that the total surplus has changed by minus BD plus E. Again, minus BD is the deadweight loss associated with this import tariff. We always have that impact or that effect. But now E is the terms of trade effect, which could possibly outweigh the deadweight loss. All right? So if that was the case, then total surplus, the change in total surplus from the import tariff could actually be positive, which would mean that the import tariff actually increased national welfare for this country. Of course, we have to be careful here. There's two caveats that we have to really carefully point out. One, this assumes that the foreign country does not retaliate. If this import tariff leads to a trade war, then all countries will be worse off. That is, we're going to get closer to autarky or no trade situation, and everybody's going to be worse off. That's the first problem. The second problem is that this kind of thinking is going to be subject to special interest politics. That is, these producers who are asking for the import tariff, they will always be asking for a lot or very high import tariff. If the import tariff is very large, then the deadweight loss areas, B and D, will quickly, very quickly, outgrow the area E, and the net effect will once again be negative. So, but if you can avoid a trade war and you can contain the special interest politics so that you only do a small and infinitesimal import tariff, then you could make the large country better off by using an import tariff compared to absolutely free trade. All right, so this is a very important point because this has shown that free trade in general is not always the best policy. Of course, you have to be very careful. There are some serious caveats here. Trade wars and special interest politics, which is likely to be important in the real world. But theoretically, it is possible to make a large country better off with an import tariff. That's it. Thank you very much.